Again, good morning and welcome to Unclaimed Property Reporting 101, the fundamentals of unclaimed property. All microphones should be muted and cameras off. If you have questions, please type them into the chat, which is located up above. You should see a little icon that says chat. Simply click on that and type in a question if you have one, and we'll address them as we go. If we do not get to your question, we will reach out by email to answer the question. This webinar will be recorded and made available on our website. With that, I will turn it over to Susan.
Well, good morning, everyone. My name is Susan Dollinger, and I am the director of the Unclaimed Property Division of the North Dakota Department of Trust Lands. When I started in unclaimed property in early 2015, I came in with exactly zero experience. So with that being said, I absolutely understand the many questions that arise with the minutia of unclaimed property reporting and what probably feels like a culture of constant change. If any of you have been doing this for a while, you've seen this program change continually since at least 2015. I would like to welcome you and thank you all for joining us today to hear about the fundamentals of unclaimed property. It looks like we have a pretty large and diverse group, so I'll do my best to make the information relevant for all of you. We do have a lot of information to get through today, so if you have questions as we go, please enter them in the chat and I'll do my best to answer them either at the end or as we go, depending on what time allows. So let's get started here. What is unclaimed property anyway? There are two very distinct sides to unclaimed property. The first and foremost is the claims side of the program. That's the good stuff. That is where the division gets to return money to its rightful owner every day. We really do have the coolest jobs in the state. It's like the greatest lost and found. It's so fun to be able to do that. And if you hadn't heard, we recently reached the milestone in North Dakota of breaking $100 million of money that has been returned to the citizens of North Dakota. Excuse me. The claim side is the front face of unclaimed property. It's the thing that everybody wants to talk about. The other side of the program is holder reporting. This is far less fun to talk about and much more confusing. Probably none of you have ever had a family member say, "Hey, I had the best experience with making an unclaimed property report." So that is why we're here today, to give you the fundamental tools you need to timely and accurately submit your reports. The bottom line is, if we don't get the money in here, we can't get it back to the owners. It is no secret that almost nobody enjoys preparing unclaimed property reports. In fact, normally it's the new guy who inherits that responsibility with little or no guidance along the way. So if you are feeling overwhelmed, you are not alone. And again, I most definitely understand the questions that seem insignificant, but they really are not. So if you have questions, please ask them. When we're talking about unclaimed property, in this context, unclaimed property primarily consists of monetary items. They're liabilities that are on your books for which the owner has not made any attempt to recover it. The only tangible property that we accept are items from abandoned safe boxes. So let's move on to some key terms necessary to understand as we move through this tangled web. You will hear the terms abandoned property and unclaimed property used interchangeably, but they don't really mean the same thing. Even the most seasoned unclaimed property professionals use them interchangeably, myself included. While while property is in the custody of holders, that's you, and there has been no owner generated activity or the owner cannot be located, the property is considered abandoned. Once the property is reported and remitted to the state is when it technically becomes unclaimed property. The holder is the entity in possession of property belonging to someone else. Holders are not limited to any particular size or type of entity. Any business, large or small, any nonprofit or government agency is potentially a holder of unclaimed property. The owner is the person or entity with the legal right to the abandoned property. Keep in mind that businesses can also be owners. There are states out there that have a business to business exemption, but North Dakota does not. Um, Due diligence, that is everybody's favorite task. Due diligence is a reasonable and prudent effort that must be taken to locate the owner and return the property to prevent it from being to prevent it from being reported, because really the bottom line is we don't want it here. We want you to get it back to the owner before you must report it. The dormancy period, that is the amount of time as defined by century code that a holder must hold property before reporting it as unclaimed. What we have here is a list of the most common types of properties we see in our office. Depending on your type of business, you may have only one or two of these, or maybe you have more than that. For example, a financial institution would have abandoned checking and savings accounts, but it would be unusual for them to have mineral proceeds to report. Another example would be a restaurant. It would be common for a restaurant to have payroll items to report, but probably not money orders. So you'll have to go through these lists and find the properties that are appropriate for you. Before we get too deep into this conversation, I wanted to touch briefly on the history of unclaimed property. Um, Escheat, there's another word that is often used incorrectly. Um, oh, Modern day unclaimed property, what we do today is derived from the historical practice of escheat, meaning that if a landowner had died intestate and there were no legal heirs, and this was, like 14th century England, if the landowner dies without a will, the government assumed ownership of that property and they took it and they used it for the common good of all citizens. Today, unclaimed property operates a little bit differently. Today, unclaimed property has nothing at all to do with real estate, but rather those monetary items, such as those that were listed on the previous slide, the state assumes the liability and the custody of the property, but never ownership. It always belongs to the original owner, and it remains in our custody until such time as the rightful owner makes a claim for that property. Now, who benefits from unclaimed property programs? Uh, the answer to that is everyone does. The owners, obviously, holders, and the citizens. And how that works is for the owners, unclaimed property is the ultimate consumer protection program. More often than not, the owners have forgotten about it, or they didn't know the property existed to begin with, or they moved and you can't find them. Um, the, it's like I said, it's the ultimate consumer protection program. As we mentioned, the states maintain custody and never ownership. Another benefit for owners is a central location for them to search and claim their property. And there is absolutely no time limit when owners can make a claim. We hold it into perpetuity. So what are the benefits for holders? For holders, once a holder transfers abandoned property to the state, the obligation is removed from its books and records and the liability is transferred to the state. At this point, the obligation becomes ours. Sometimes there's a dispute with a particular kind of property. An example of this would be a real estate transaction. So if there was a dispute between the buyer and the seller and the earnest money had been paid and they can't agree and the buyer backs out, now they don't know what to do with this money and there is no agreement. The realtor may have these funds held in a trust in the name of both the buyer and the seller with no resolution in sight. After 3 years, the funds should be reported to Unclaimed Property Division as a multiple owner property. It would be in the name of the buyer and the seller. You get to remove your obligation, um, and if the buyer or the seller comes forward, we're going to require a claim for both. So you are relieved from that conflict, and now that is on us. Another benefit for the holders is that the holder is indemnified, meaning that once you turn it over to us, you're completely free of the liability and it's now on us. Um, so what is the citizens benefit? The benefit is that the state has the use of the funds to benefit all citizens. Little more history lesson than you probably wanted today, but in 1889, North Dakota was admitted to the Union through the Enabling Act, along with South Dakota, Montana, and Washington. Each of these states was granted land from the federal government for funding public education into perpetuity. In our state, these school lands are operated by the Department of Trust Lands. In 1975, the North Dakota legislature authorized an unclaimed property program and felt it appropriate for that abandoned property to be placed in the Common Schools Trust Fund. While it is true that many, if not most, unclaimed property programs are housed within the treasury of that state, in North Dakota, like I said, we're housed in the Department of Trust Lands where the Common Schools Trust Fund is managed. When we receive abandoned property through a holder report, it is immediately credited to the Common Schools Trust Fund, where any income earned while it is invested becomes a permanent part of the trust, helping to fund K-12 education in North Dakota. And I think, my personal opinion is that is fantastic. Um, so each state does have the authority to determine what it does with the funds while it is in their custody. While it is true, excuse me, that some states do place the money in their general funds, there are many that do not. And it never ceases to amaze me the diversity in how states use the funds to benefit the citizens of their state in different ways. You can see from this list here that a tremendous amount of positive comes from unclaimed property. Next, coming up, we're going to talk about some of the myths associated with unclaimed property. Myth number one, my organization does not have any unclaimed property. Well, the truth behind that is any entity who handles money in any way is potentially a holder of unclaimed property. For example, if you have employees, sooner or later you will have a payroll check that doesn't get cashed. And that's a lot of times where the first question comes from is I have this paycheck that I don't know where this employee went and I don't know what to do with the money. That's usually how it starts. So really any business regardless of size, is potentially a holder of unclaimed property. Myth number 2, my organization is only required to report to North Dakota. Um, the truth of the matter is, we'll get into that in a little bit more depth later, but the truth is there are holders, maybe some of you in the audience today, which will be required to report to all 50 states. Myth number 3, reporting is voluntary. Unfortunately, it is not voluntary, it is the law, and it has been since 1975. It is not a punishment or a suggestion, it is simply the law. Myth number 4, unclaimed property is a money grab by the states. I'm sure you've all heard that, but it is simply not true. The truth is that unclaimed property is a protection for the citizens. Our ultimate goal is and always has been to get the money back into the hands of the rightful owner, while at the same time preventing holders from practicing lucrative silence, which is holders benefiting financially from money that doesn't belong to them. If they don't say anything, if they don't report and remit that property, then who's benefiting? Now, we'll get going into the really, really important stuff, the holder reporting process. And that can be summarized into 5 simple, okay, they're not simple, none of them are simple, but 5 steps. Number 1, identify any unclaimed property. Well, I guess if it's, you see, I'm already using abandoned and unclaimed interchangeable. Number 1, that should say, identify any abandoned property you may be holding. Number 2 is perform due diligence. Number 3, report to the appropriate state. And like I said, we'll get into that a little bit deeper in the next couple of slides. Then remit your funds to the appropriate state. And last but not least, know the law of the entitled states. So step number 1, identify dormant property. So I got it right on that slide. The first thing you will need to do is review your books and records to identify any dated or outstanding liabilities where there has not been any owner-generated activity. The next slide will answer many of the questions that you're all thinking about, but most importantly, how do we determine the dormancy period? The date you want to start with when determining the dormancy is June 30 each year, which is coming up here in a few days. Depending on the dormancy period of the particular property you'll be reporting, you will calculate backwards from June 30. Once you have determined which properties may be reportable, you can begin the next steps of due diligence and preparing your report. At this point, I want to just pause and take a moment to emphasize the report due date. It reads in the law before November 1. So what I would encourage all of you to do is get started on the process right away, because you don't have to wait until October to submit your report. If you review your records next week and you realize that you only have one outstanding check that you need to report, send that due diligence, give them a chance to respond, and then submit your report. Once you have it ready to go, you can submit it. So if you wanted to get started, you can go through your records and send out your due diligence on June 1st and then have your report ready to submit on July 1st. It's the report due date is just a period of time between July 1 and November 1 that you have to get that report to us. So don't wait. Don't wait till October. So when does that dormancy clock start? The dormancy clock is triggered by the last documented owner-generated activity. This is important for properties that are held on account where a check was not issued. Examples of these are bank accounts, overpayments, credit balances, dividends that are being paid, and royalties. For uncashed checks, the dormancy period is 2 years from the date that check was issued. When we updated our law a couple of years ago, we did standardize the dormancy period for all uncashed checks, regardless of if it's a cashier's check or a treasurer's check or what have you. All uncashed checks are now 2 years. And to put this into a little bit of a realistic scenario, any checks that were issued on or before June 30th of 2021 are reportable before November 1 of 2023. So let me say that again. Any checks that were issued on or before June 30 of 2021 is what needs to be reported this year. So I bet some of you are wondering now, is there anything that restarts that dormancy clock? I just saw a question come in about reissuing a check. Um, so what there are some things that do restart the dormancy clock. However, it must be documented. If you have written communication from the owner, if they call in and say, I got this letter, what is this? Yes, I still want my savings account. Then document that phone call and the clock starts over. If you get an email from an owner or something like that, that can be documented and followed up with, that does reset the clock. Or if there's any other documented interest in property. To answer I'm looking back and forth between the questions and my slide. If you had a check that was reissued, the dormancy period is still the date on the initial check. The liability started when you issued the first check. So voiding and reissuing a check doesn't restart the clock, and nor does it negate the liability. So the dormancy period in a reissue situation is the date on the original check. And to be clear, the dormancy period in North Dakota for checks, uncashed checks, is 2 years, not 3. Um, so anyway, I digress. There are a couple of scenarios where the dormancy clock is reset. There are some things also that do not reset the dormancy clock. If you are, say, a financial institution and you're mailing monthly statements and the statements are not returned as undeliverable, the simple act of mailing those statements is not considered owner-generated activity. The customer would have to initiate either a deposit or a withdrawal or a phone call or something that can be documented. Then that dormancy date would be calculated from the last deposit or withdrawal, has nothing to do with the statement date. Another thing that does not reset the clock, if you have a credit balance on an account and the customer is still purchasing and not using that credit balance, you need to get in touch with them and do something with that credit balance, because that um, you just want to be in good contact with your customers. If you have a type of account that automatically posts interests, that interest payment that automatically happens is also not owner generated activity. So that does get a little gray as far as the dormancy period goes. I'd see a question here that says, what if the owner is deceased, but a family member reaches out? does that reset it? That kind of depends on what kind of property it is. If it's a checking account and the owner is deceased, the family will probably take care of it. But I guess it really just depends on the type of the property. So generally, I think the general answer to the question, if an owner is deceased and a family member reaches out, does that reset it? No, it doesn't. But it does give you a chance to take care of it. Royalty interest in specific. That is an excellent question, and we'll get to that later today or maybe tomorrow. But the dormancy date for an interest, for royalty interest, starts from the dormancy clock starts on day one. And if you're paying interest, once that very first interest payment reaches 3 years, that's when the dormancy period, the dormancy clock kicks in for the minerals. So anything that's payable after that initial 3 years is all abandoned. So anything after that initial 3 years is reportable. Okay, I'm going to move on to due diligence here, and I have kind of a strange affection for due diligence. I don't know why. Um, it it just is near and dear to me. For unclaimed property reporting purposes, due diligence is that final attempt that you have to make before you start your reporting process. You can reach out to your customers however you want to, as many times as you want to. When I talk about due diligence, I am only talking about this final attempt. Um, One thing that did come through in our when we updated our law a couple years ago was the requirements that must be in every due diligence letter. It's in the law and it's very, very specific. So the final attempt must not be sent more than 120 days before you submit your report. So you can start your due diligence in May or June. Um, and the reason for that is so that you can get your report done and you don't have to wait until October. Um, that will give you plenty of time for the owners to respond and prepare your report. While you are required to give the owners a particular amount of time to respond, I wouldn't give them too long because we all know that you send out this mailing and either they're going to respond or they're not. Whether you give them 7 days or 90 days, um, I would pick something in the middle, like 30 days, because the ones that are going to open the letter and read it and respond are the ones that are going to do it in 7 days. Um, so I see a question that, no, it looks like Jessica answered the question. Um, Under forms and resources on our website, you will find several examples of due diligence letters that do meet all of the requirements. So remember, um, each due diligence letter must contain the following things. It must have a notice, like is shown on the screen there. It's probably pretty tiny for what you're looking at, but it has to have a notice. And if you look at the law, it's very specific, the verbiage that has to be in it. Number 2, it must identify the holder and provide contact information. That's you. Identify the nature and value of the property. It must state that the property will be turned over if they don't respond. It also must state that the owner will have to file a claim with the administrator if they don't respond. And then it also must have instructions for the owner to get their property from you directly to prevent it from coming to us. And like I said, on the website, under forms and resources, there are examples, and you are certainly welcome to hijack those words, copy and paste them into your own letterhead, and just fill in the blanks. That's why they're there. So if there's one for dormant accounts, there's one for uncashed checks, and there's one for safe boxes, I think. So so now that your deadline has passed and your due diligence is out and you're ready to start your report, um, we will talk in great detail tomorrow, um, some of the details, how to actually generate that report and what the NAPA format really is. Um, Jamie, if we have several states we remit property to, do we need to use state specific due diligence letters? The short answer to that is yes. But what I will say is um, the examples that are on our website are specific to the newest version of the uniform law. So if your other states have the same law format that we do, this should work for all of those, but you would want to definitely double check the requirements. Okay. Um, where was I? Okay. So before you start generating your report, you're going to need to determine which state or states you need to report to. We're going to generate that electronic report in the NAPA format. Um, and along the lines of which state do I report to, you're going to have to know the due dates of the other states because they are not all October 31st. Texas v. New Jersey Supreme Court ruling that was handed down on February 1st of 1965, which is really not significant except for it does drive where the property is supposed to be reported. This ruling established jurisdiction that abandoned intangible personal property lies in the state of the creditor's last known address. So the primary rule is to report to the state where the owner's last known address is. The second priority, number 2, if you have no address, then the property goes to the state of incorporation, which for most of you will maybe be North Dakota, but not always. So if you have unknown properties, you should really check out the laws for your state of incorporation. Priority number 3, reports. Sorry. The, Rule number 3 is the transaction rule. So if you don't have an address or anything like that, it goes to the state where the transaction occurred. And really this rule only applies to money orders, traveler's checks, and other similar written instruments. It would go to the state where the transaction happened, if that makes sense. If I write a check to an employee to reimburse him for mileage or supplies, is the dormancy period 1 year or 2? 2 years on the check. Expensed, well, that's what. Oh, Jessica's answering these questions as we go. Sorry. Okay. So after your report is complete, you want to remit. So for us in North Dakota, whether you use our manual online reporting tool or you upload a prepared NAPA file using a third-party software, the requirements are as follows to remit your property. For reports totaling less than $10,000, we use a third-party uh, payer. It's called NCR. I'm sure you've all heard of NCR, to process ACH debit payments directly from the website. So you hit submit, it says your report's been submitted for processing, then you go to another page and you can make your online payment directly if it's less than $10,000. If your report totals more than $10,000, we would ask that you as the holder initiate an ACH credit or a wire. Negative reports or zero reports, um, we get this question a lot. Negative reports are not statutorily required. However, the submission of such reports is strongly encouraged and is considered to be a best practice by accounting professionals. Filing a negative report shows that a holder has awareness of the legal obligations of unclaimed property and compels an annual review of books and records. Filing a negative report on our website is super quick and easy. I'll show you this tomorrow when we have the website up and we're actually looking at things step by step. I'm going to answer this question that I knew was going to come. The question is, can our company pay by check instead of wire or ACH? The answer to that is yes, we still can process a check. However, the ACH options are preferred, but sometimes it isn't an option for the holder. And so, yes, we still can process a check. If you must send a check, we need to have a copy of the um, report confirmation upload mailed along with your check. Okay, I'm going to come back here to maintain records. After this is something that most holders miss, and that's why I want to stress this record retention. After you've reported and remitted your unclaimed property for the year, the final step in this process is to retain those records. North Dakota Century Code 24-30.2-24 states that a holder required to file a report shall retain records for 10 years. It further outlines the specific details that must be maintained, but for practical application, the specific details are much the same as the information you will have provided in your holder report. North Dakota's record retention for unclaimed property reports has always been 10 years. It's imperative that you keep these records in the event that you wake up one day and the unclaimed property police are knocking at your door. Which leads me to our final point of discussion, which I think we have a question that will happen. I'll answer as we go through this, but keep those records, because if you don't, it could come back to bite you. And here's why. What is the risk of non-compliance? North Dakota Century Code gives the Unclaimed Property Division the authority to examine the books and records of any holder that is suspected of not being in compliance. However, audits are very time consuming, not only for us, but for you as the holder. They're time consuming, and some would even say invasive. So before we move ahead with an audit, we would offer enrollment into what we call a voluntary disclosure program. And what this voluntary disclosure is kind of a watered down version of an audit where the holder is allowed to complete a self-review of their books and records with the assistance of one of our third-party contractors that can walk you through that in much better fashion than I ever could. So if you discover that you may be out of compliance, it's a good idea to contact us and get enrolled in that voluntary disclosure program. And the reason is because we will waive any penalties or interest if the program is completed efficiently and thoroughly. If that doesn't work out and we do have to perform an examination, we would likely assess penalties and interest for the late reporting. It's also important to note that in either scenario, we can look back 10 years plus the dormancy period. So it is vital that you keep those records for the full 10 years, because if you don't, we also have the authority to use estimation techniques based on an industry standard or other types of things that make sense. Like if you're a hotel and you're on and Hotel A is reporting $15,000 of unclaimed property every year for the past 20 years, and Hotel B has never reported, and Hotel B doesn't have any of those records, we're going to assess estimation tech use it we're going to use estimation techniques and make your liability look closer to what Hotel A reported. So keep those records. And with that, we have come to the end of our slides. I'm gonna kind of scroll through these questions here.
Yep, we do have a few questions that weren't answered yet. Jody's question: what if buyer is out of state address and co-buyer is in state address and check was not cashed?
That's a good question. The first priority, I think, would be to the state. I'm going to say the North Dakota address. I'm hoping it's a North Dakota address, but I can see where that is an issue. But I would say they're co-owners, right? So you as the holder, that if they're co-owners and one is in North Dakota and one is in Wyoming, I would report it to North Dakota, because you're not going to split it in half. I mean, you could, but we wouldn't expect that.
And then another question: for restitution in criminal cases, if the victim moved to another state, unclaimed property still goes to North Dakota, correct?
If you have the new address for the victim in another state, then you would send it to the other state, unless you don't have an updated address. Because you want to go with the address that the last known address you have in your records. You know, the expectation isn't that you would employ all of the skip tracing techniques that to try and find them. You'll only have to go as far as the information that you already have.
And for a utility company, if the property is in North Dakota, but they live in another state and check was sent to that state, we have to submit the abandoned property to that state and not North Dakota.
Correct. If that's where their physical address is. We get we see those a lot. Small checks that aren't cashed from, a lot of times they live in Minnesota, but the property is in North Dakota, or vice versa. Sometimes they live in North Dakota, but Minnesota is sending us property. So it goes both ways.
Another question: what do we do if unclaimed property is discovered that is beyond the dormancy period? For example, the unclaimed property should have been reported in 2022, but didn't get reported until 2023. Are there any penalties?
You know, we understand that this is something that you folks only do once a year. It's not your primary responsibility. If you discover something like that, shoot us an email or give us a call. We're pretty forgiving. Um, I sound kind of tough when I say there's penalties and interests. Um, we our first go-to is not to punish. We want to make sure that you understand the requirements and the responsibilities. So if you came across something that you missed last year, just call us. We'll make sure that you get on the right path. And so to answer that question, no, we wouldn't charge interest or penalties if you come forward. If you uh, aggressively refuse to pay or report, then we would probably entertain penalties and interest. But for those folks that want to be in compliance, we want to help. We're not here to punish.
Another question. If we are a state agency and our only items to report are uncashed checks, does the state treasurer's office do the reporting for us? And then they stated that they do their own due diligence.
Yes. Um, if the state treasurer issues your checks, they do the reporting. And I can only speak from the perspective of the Department of Trust Lands. We do our own due diligence, but the actual report comes from the treasurer's office. So if you take nothing else away from this um, webinar today, please go out to our website and look at the due diligence letters that are out there, because um, that is only, the due diligence is a piece of the process, and own it. So if that's the part you're doing, then please go out there and check those examples that are there for you.
Um, Another question, if you have multiple NAPA codes to report, can they be reported in one file or do they need to be separate reports based on code?
Um, we are going to get into the weeds tomorrow about property type codes and dormancy periods and manual online reporting and the steps to do that. But the short answer to your question is they can be reported in one file.
Okay. What if a customer has moved to Canada?
That goes to North Dakota. We do actually get quite a few um, claims from Canadians. Not quite a few, but some. We do get people from Canada making claims.
And then if an owner is deceased and the check was returned, do we have to hold it for the 2 years or can we report them early?
Great question. That is an excellent question. Early reporting is allowable under our law. But before you do that, you have to have written approval from the administrator. So just send us an email and explain the circumstances, why you would want to report that early. And then you'll get a response from us that says, yes, I approve early reporting if your owner is deceased and there's no other family members. The other thing that you would have to do is provide documentation showing that the due diligence has been completed. So yes, you can report early, but you have to have written permission first.
And a couple of remaining questions have to do with, will there be a new link for tomorrow's meeting? Uh, yes, a new link for tomorrow's meeting will be emailed to all of the registrants today.
Yes.
So you'll click on the new link for tomorrow's meeting at 10 o'clock Central Standard Time.
Yes, and that'll be well, I sure hope if any of you have questions that you think should have been answered or you didn't want to put in the chat, you can email them to unclaimed@nd.gov and we can address them at that. If personally. So with that, I will give you all 10. Can Moorhead's owners be on the North Dakota report? No, sorry. Just like, unfortunately, no, they have to go to Minnesota. If you know they live in Moorhead, they should go to Minnesota. What I will say about that is we can accept incidental reciprocal properties, but technology is such that, especially if you use a third-party software, and we'll talk about this more tomorrow, that third party is going to take your information and divide it into the states that the reports need to go to, and really all you have to do is go back and upload the report to the right state. But now I'm getting ahead of myself. So for those of you that are new to this, hang in there. If you ever have questions, give us a call. But with that, I'll give you a few minutes back to your day, and we'll start again tomorrow.
Thanks, everyone.